$1 million question, right? If you had to pick, what do you think? S&P towards the end of the year, or I guess overall market?
I hate you do this.
Hello, Apriem family, and welcome to episode 12 of Apriem Financial Cents. As we kick off 2024, I sit down with Benjamin Lau, our Chief Investment Officer here at Apriem Advisors. He's going to give us a summary of right at the end of 2023, a little bit of the excitement that happened there, and then discuss a little bit of what expectations are as we move into 2024. Hope you enjoy the show. Thank you again for subscribing.
January 2024. Happy New Year.
Happy New Year.
I think that last year kind of ended on a bang.
Yep.
I guess as we look at 2024 and moving forward, I guess you want to wrap us up. What happened right at the end of last year, and then let's talk a little bit about what expectations and thoughts are as we move into this next year.
Last year was such a surprise. No, I mean we've been talking about what a surprising year last year was in terms of what we thought what was going to happen, and then what happened at the end of the year, like you said. I mean, every Wall Street economist was so certain we were going to have a recession in 2023. First half of 2023, second half of 2023, but everyone was so certain that we were going to have it, and it didn't happen. The economy ended up chugging along, I think, a lot better than what people thought.
Right.
And so inflation started coming down. Right, and inflation did start coming down pretty dramatically, which I think was what helped the stock market do so well. A lot of the supply constraints, a lot of the supply stuff, it ended up getting better. A lot of the demand started easing up, and inflation just started coming down pretty quickly.
Right.
And so now we're not quite to where the Fed needs to be once inflation, but we're kind of heading in that direction. And that, I think, gave the Fed a lot of room to pause interest rate increases last year. And I think that's really why the stock market ran for most of the first half of the year. And then what was even more surprising was how we finished the year, right? The last really 8 to 12 weeks of the year was a ferocious rally. That really, what spurred it on was really when the Fed said, I think we're done.
Right.
But I think we might be pausing here, and then we might be cutting rates soon, and that just caused the market to really light a fire. Not just stocks. Stocks finished the year quite strongly. Bonds also did well.
Right.
Bonds were in the red for most of the year, and in the last 8 weeks of the year, they were up low single digits.
It was like the minute we got out of October.
Exactly.
All of a sudden, everything was just like November 1st, everything just like trucked up.
Exactly. And not even just the tech, right? For most of the year, technology, the Magnificent Seven stocks we've always talked about did well.
Yeah.
But the last 8 to 12 weeks of the year, you're right, everything rallied, right? It wasn't just tech. It was broad-based blue chip stocks, dividend stocks, other sectors rallied, bonds rallied, international rallied. So it was a broad-based rally that led us into this year. So.
Right. I think a lot of that, as you had mentioned, I think a lot of that was kind of going off of this thought of more rate increases, right? And is that still kind of the case? Are we still thinking that?
Well, clearly I think
did I say increases?
Yeah. Okay.
Rate decreases.
Yeah.
Rate decreases.
Yeah. Clearly, the market is thinking that the Fed is going to start cutting rates. Right. There's been some debate about how much it is. The Fed itself, right? The Fed puts out a survey after every meeting called the dot plot, and the Fed's own governors, the people that actually vote on policy, right?
Right.
They're thinking that rates are going to be lower by about 0.75% this year. By the end of the year, they're going to lower rates by about 75 basis points.
Sure.
That's probably going to be about 3 interest rate cuts of about 25 each, right?
Okay.
The market is closer to about 250 basis points in cuts, right? You're looking at 6, 7, maybe even 8 cuts this year is what the market is forecasting. I think that's pretty aggressive. I think the market is maybe being a little too hopeful that the Fed's going to be that dovish and rescue the market.
And so when we say the market is predicting, let's say, roughly 6 rate cuts this year, are we talking like the futures, the Fed funds futures rate that we're kind of looking at there? Or?
For this, yes. I am specifically talking about the Fed funds futures. This is a lot of investors, big investors, small investors, kind of pricing out what they think interest rates are going to be throughout the whole year. Right. But not just them, too. In the past couple of days, we've had banks reporting their financials, right, their quarterly numbers, and even banks are predicting that. J.P. Morgan, for example, in their forecast for what they expect to make, net interest income they're forecasting 6 cuts this year too.
Oh, wow.
So you're seeing the market predict that, and you're seeing banks internally predict that too.
Oh, what about you? What are you thinking? I mean, you thinking that many cuts this year?
No, I'm not thinking that many cuts. I think a 3 is probably where the market should be. Remember, since all this data we've been talking about, it came out, we've had some more economic data, right? It's the beginning of the year. We've got some news that inflation, CPI came out last week.
Right.
Things are pretty warm. Things haven't cooled down that much, right? Inflation has come down from about 7 to 3%, but that last move from 3% to 2% might be a lot harder than people think to get down, right? You're still seeing elevated cost, and a lot of things we still use, right? Travel is expensive. Gasoline is still relatively expensive. Right. Home prices, rentals are still really expensive. Eating out, travel, anything that's related to kind of labor market services is still staying quite hot. And I don't know if that's gonna I think it'll be a huge question if that continues.
And so I think core inflation ticked up. Well, didn't necessarily tick up, but it came in higher than expectations. Is that correct?
Yes.
They were thinking about 3.8, came out 3.9. Okay. All right.
So a little bit hotter, right? Everything that we use, it's not just oil and gas and food, right? It's a lot of things that like travel's a big one.
Right.
Travel's a big one.
And so something like that, still potentially 3 rate cuts, but maybe pushes when that first cut comes a little further back in the year. We're thinking March originally, and now maybe April, May.
Yeah. So when we first did our write up for the year, right, we did it in December, and the market was predicting a lot of rate cuts, but starting in March. I think that's coming off. I think the probabilities of a March rate cut is coming down. That inflation print that we got last week was pretty hot. Today, we're obviously recording this on the 17th of January. Right. Today, retail sales came in pretty warm. Okay. Again, it turns out that people had a pretty good holiday season and spent a lot of, they started buying stuff again, right? They started buying a lot of merchandise, a lot of clothing, a lot of good stuff did well over the holidays. And so retail sales is pretty strong.
So, I mean, retail sales strong. Yes, inflation it's coming down, still slower than I think any of us would like. But we sidestepped recession last year. Is recession still on the table? Or have we kind of hit that soft landing? I mean, it's kind of rocky start at the beginning of the year. What's going on there?
Yeah, everyone is now predicting, and everyone, I mean, most every Wall Street economist has now been talking about a soft landing, right? The consensus for estimates is for last year's GDP growth, like how well the economy did last year, 2.25% last year is what they're expecting for 2023. We're expecting it coming around 0.9 to 1% this year. Okay. So the economy is slowing down, right? But not enough for a recession.
Right.
And so that's why everyone's predicting, the economy's slowing down. The job market is pretty healthy. So that's why everyone's calling for a soft landing. I think it's gonna be a little rocky than that, Josh. I think that we're seeing some weakness in some areas, some strength in some other areas, and so I think it's not gonna be an easy path for this economy to slow down.
So slower economy makes it a little bit tougher to navigate. So maybe a little bit choppier, at least in the first quarter, first half of the year.
Yeah, I really think the big catalyst for that will be as we push out how many and how soon interest rate cuts are going to happen. The market's going to have to get some used to that.
Okay, all right. So what do you got for us here? Is this first page of the market update here?
Yeah. Well, I mean, we wanted to point out on the charts here how this, the economy is doing quite well, right? Although things are slowing down, we're still kind of going up and to the right,
which is the direction we want to go.
Which is where we want to go. And not only that though, because we really don't invest in just the U.S. economy, right? For our clients at Apriem, we really invest in individual companies. We want companies to make more profits, right? Yeah. And so this year, I think the reason why I'm still optimistic for this year is I really think that profit growth is really going to kick into another year for this year. Last year, I think it was really a year of cost cutting by many companies, by many large American companies. They were cost cutting, laying off people, reducing expenses, headcount, and so profits were relatively flat last year. I think this year profits can start going higher, and so I'm pretty optimistic for the year.
Okay, all right. So you kind of mentioned the amount of cuts, and thoughts on that. We've got some data here, for the crowd. You want to talk a little bit about what we got on the charts here and where those expectations come from?
The chart on the left here from JP Morgan shows where Fed funds are currently right now, right? The rate that the Fed controls here, short-term interest rates, and where they're expected to go over the next year to 2 years. And so the Fed predicts about 3 interest rate decreases this year, bringing it from about over 5% to in the neighborhood of maybe the 3.5% over the next couple of years.
Okay.
But the market's even more aggressive. You can see that the green dots are showing a much steeper decline in short-term interest rates. So the market is much more, I guess, bearish than the Fed themselves. I don't know if either this is going to happen. Right? The Fed dot plot is notoriously volatile. It changes from quarter to quarter, and I think the economy is that strong where I don't know how quickly the interest rates are going to need to be cut to support this economy.
Right.
I think there's a lot of concern that inflation is still embedded in the system, right? And really hasn't been completely vanquished. And so, and we kind of had this problem in the 70s where the Fed thought inflation was vanquished. We started cutting interest rates in the mid 70s, and clearly it wasn't. It was probably too soon, too fast, and that led to the really high inflation that we all think about in the 80s, right?
Yeah.
People forget that there was it was predated by high inflation in the mid 70s, and so it was kind of a knock-on effect.
And so, what do we have on the right-hand side here?
On the right-hand side is one of the reasons why I think that the consumer is actually still pretty strong, right? Again, we talk about this almost every quarter, that the consumer is about 70% of the economy.
Right.
How are they doing? Consumers have record credit card debt right now, right?
Right.
You're seeing. But I wanted to be more the glass is half full. I think the consumer is actually doing pretty well. Okay. And I think this is one of the reasons why I think the Fed's not going to cut interest rates as aggressively. And what JP Morgan did here was list out all the consumers' assets and their liabilities, right? And so, yes, liabilities have risen to about $20 trillion recently. But look at the asset side. Americans have a lot more assets now than ever before, right? Home values are up, their financial accounts are up, their retirement accounts are up. Add to this, consumers have over $6 trillion in money market funds on the asset side. Where does that go?
Yeah.
Right? And so that I think that's another half glass, the glass is half full kind of scenario.
And so essentially what this is telling us is that, liabilities are up, but consumers have assets that they could tap into in the case of the emergency to handle, the pressures of those liabilities. Again, original comments slows the economy, right? Because when we spend on credit, right, we're just taking from future spending.
Of course.
We're spending it now, right? And so eventually we got to get to that point where we pay that back, and that means we spend less, right? And the economy slows down, right? Which kind of I think goes into to all the conversation we've had thus far, right? A little bit slower as far as GDP goes this year, right? But not necessarily detrimental, not necessarily anything that really is pointing to recession.
Exactly.
This year, okay, which is that. Yeah. Rocky soft landing.
a bumpy landing, right?
Yeah, the bumpy landing. Okay. So what about these late cycle opportunities?
Well, I mean, again, I think that the economy is still in a great place. I think corporate profits are still in a good place and growing it and quite strong. But where are the opportunities today, right? And last year was a great year, especially for certain sectors of the economy, right? And we talk about the Magnificent Seven, these technology stocks, and they've done quite well, right? A lot of these technology stocks did see a lot of growth, but they also see a huge rise in their price. So now valuations are expensive,
right?
And so you can see here in the top 10 companies in the S&P 500, the valuation has exploded, right? You're looking at about 28 times earnings. That's expensive, right? That's not the highest it's been, but it's near the highest levels. But what happens if we just said, well, let's exclude those top 10 names. Let's just look at the other 490 names in the market, right?
Right.
And you can see the valuation for those companies, the ones that kind of were ignored last year. Those valuations are quite cheaper. And so that's the thing, is that as we enter a slower part of the economy, right? I think growth is going to broaden out. And there's going to be growth. There's going to be opportunities in many names, not just the top 10 names. I think you're seeing a lot of names still do relatively well in terms of revenue growth, in terms of cash flow, free cash flow growth. And so I think those are names that go after. And they're now you get a better margin of safety. They're cheaper than the top 10 names.
So essentially, if I were to summarize, right, the Magnificent Seven last year, right, we got them at good prices. We were able to hold them throughout last year, and they created great returns for us. This year, I think a lot more of the returns is going to be in identifying some of those other 490 names that maybe didn't soar last year, but are available at good prices this year.
And they're still growing.
Right. They're still growing.
And they still got great margins, usually great management. They got a great competitive advantage, right?
Right.
And they're doing something well, they're gaining market share.
Right.
And so those are the companies that, I think we should be looking at.
They cleaned up their balance sheet, right? They cleaned up their expenses. They got kind of prepared for this recession that we never saw.
They got lean and mean.
Lean and mean, and now they're in a really good position
Exactly.
to continue to do well and experience some growth this year, even when the broader economy is slowing.
Exactly.
Okay. I do want to briefly discuss, we talked about interest rates, but let's talk about the inverted yield curve. It's been inverted for over a year now. I mean, what has to happen? I mean, an inverted yield curve doesn't necessarily signal a healthy economy. How does this get back to, what does the economy look like as this moves back into a healthier yield curve? Is it longer rates going up, or is it the shorter rates coming down?
First of all, the yield curve that I'm going to refer to is the 10-year Treasury, which is what we consider the benchmark U.S. Treasury, versus the 2-year rate.
Okay.
Which is not quite what the market controls, but that's kind of where the Fed funds controls, right?
Okay.
Since October, both of those yields have come down quite a bit.
Okay.
And so much so is that the yield curve, actually on the short end, has come down more than the long end, making the yield curve actually less inverted.
Starting
slowly.
to flatten slowly?
It's starting to flatten slowly in a better way over the last 3 months. I think what's going to happen if for the yield curve to get uninverted is that the short end will probably have to come down a lot more than the long end.
Okay, and that's going to really just have to do over the next couple of years, really, as the Fed slowly but surely begins to cut rates.
Exactly.
Okay.
And I don't think it's going to take much. I think you're looking at the neighborhood of maybe 2 interest rate cuts by the Fed to uninvert the yield curve. And so
Okay.
we're not that far off. The yield curve has gone substantially flatter since the last time we talked about this. And
Okay.
so it's been a big reversal, right? That last 3 months of the year, it was a big rally.
All right. And so I know there's not necessarily economic data that points to this, but I'm sure it's on everybody's mind. We're in the middle of an election year, right? And so do we want to talk a little bit about, the election, maybe what's happening geopolitically, worldwide? We have obviously some war and turmoil that's happening worldwide. That's going to affect markets, affect decisions moving forward. What are your thoughts as far as that goes? What are you guys keeping an eye on?
It's so much to talk about, right?
Yeah.
The macro policy, the macro part of the equation has been really tough, right? And it was really tough last year. It continues to be really tough this year. And not just the situation, but the market's reaction to them has been really surprising. I mean, what if I told you that we're still going to be involved in Ukraine?
Right.
We're going to have all this conflict in the Middle East, but oil prices are going to be under $70 a barrel, right? And that's shocking, I think, for many people. And now to add to this to the equation, you had we had the elections in Taiwan over the past week. That raised the tensions between Beijing and Taiwan,
right.
Which is arguably a very tough part of the world too. So we have 3 potential conflicts around the world that's tough to predict. And then wrapping up the year, we're as I pointed out, we're less than 300 days away from the American political election here, and so it's going to be a big toss-up, right?
Yeah.
It's going to be very interesting to watch. I really feel like there's still so much unknown with what's going on here in America and who's going to be in the White House, next year. Consumer sentiment is horribly low. It continues to be low. It was low in 2022 with high inflation. It was low last year, even though the market rallied quite a bit last year.
Right.
It continues to be low today with lower inflation. Americans are just not happy with the economy or their prospects, and I think that's really going to show up in the polls.
$1 million question, right? If you had to pick, what do you think S&P towards the end of the year, or I guess overall market?
I hate you do this. That's a tough one. It's a battle, right? I think even though the economy is slowing down, I think things are still pretty good, right? I think
Sure.
Ultimately investors pay for profits, and that's going in the right direction. I think through the first half of the year it's going to be really rocky. I think we might even be negative double digits by the middle of the year. But I really think the economy and the stock market is going to be up double digits this year. I think it's probably in the low double digits is my estimate. Last year was a good year.
Yeah.
History shows that good years tend to cluster around. They're not as isolated as you think, and so I'm just looking at market patterns. I think this year could be another good year. Probably not as good as last year, but I'm thinking low double digits.
Sure. I hear great years are typically followed by good years, right? Last year, great year. Next year, good year. Or this year, good year. So
they're not as random as you think.
yeah.